Good morning, ladies and gentlemen. Well, 89, what can we say? It's stuck on 89. When it comes off by a couple of points and goes straight back to 89. We're just making new highs and we're going higher. This is, the epitome of risk on. It's a trend. There's absolutely no point in fighting it at the moment. Whether you look at the weekly or you look at the monthly, same thing, scores making new highs. There's absolutely no indication whatsoever that we're about to stop this trend. I will have a look at what the bonds are saying, and those could be interesting factors. But while this is going on, you buy every dip in the stocks and you still avoid bonds. Deviations are not showing you any warning signs. We really need to be up here in the red, and you can see where that comes in. That's around 38.70, probably 38.80, which is actually coincidentally the top of the Bollinger Bands on the weeklies. It's just going to keep on going. There are only very few sectors which are in the red, and those are, you will see, XLB, the materials, which are now coming back, and also XLY. Here XLV is touching it, but XLY is the one that's in there. That could easily come back, and that's probably got to do with Tesla being so hugely bullish and but overbought. I really don't see that this is the top. When the top will be when we start going through into the red, like here, and then we can come back down. There hasn't been a single significant top which hasn't gone into the red, so I fully expect it to happen at some stage. I will examine the mathematics of what is probable as a target, as a fundamental target, and I think that's somewhere around the 3950 area, just short of 4,000, where the analysts are just getting you over bullish for this year. But one step at a time. I really do think that we are front loading this year, and that we're going to go into the 3900s at some stage in January or February before we can actually have a pause. Well, the two stands have not given us a bum steer for a long time. You can see how high we are now. We haven't been around here since 2017, when the Fed was actually nowhere near as easy as this. What does this mean, that the yield curve is as steep as it is? A lot of people are saying that's a sign of inflation. I don't think it's a sign of inflation. I think it's a sign of expectations of a strong economy and a strong rebound on the reopening of the economy, and the fact that all these analysts are upgrading the earnings of the economy on the reopening. They're now looking for $180 as opposed to $170. I don't think we will reach $180. I think we are setting ourselves up for a disappointment, and the fact that we are up here and we haven't been up here for many years. If I turn it into a monthly chart, you can see when we were around here when in 2000 and what is this, 2012, 2013. It's getting to silly levels, and therefore that is why I think it's getting very expensive to be short of bonds. So I think that we are really going to stop around these levels. I would have thought that around the 100 level is about as much as you can see this yield curve steepen, and I'm really taking off all of my steepeners and actually looking for something completely different to happen, and I'll examine that now. Let's examine first what 5s 10s are doing, and then 5s 30s, and then 10s 30s. The 5s 10s continues to steepen, and I would have thought the 5s 10s is going to get to around this 73, 74 basis points level before bouncing. I think they're all basically making some kind of a head and shoulders pattern. So what I think is happening is that dealers are going to be buying 2s, selling 5s and 10s, and buying 30s, doing a barbell. It makes sense that the 5s 10s are still steepening, but the area of the curve that's going to be the least attractive, and I would encourage you to read the interview with Fed's Clarida, which was given on Thursday, I believe. It's basically what he's saying is that the Fed is going to keep the pedal to the metal until probably 2023, 2024, and that is anchoring the 2s, and it's making the 5s more attractive than the 10s. So really the point of inflection in the curve is somewhere around 7 years, 8 years, 9 years, something like that. Because the Fed, once the Fed starts hiking rates, they should hike them to 1.5 to 2% area very, very quickly. So the 10-year becomes quite unattractive. Now, if we have a look at the 5s 30s, they've reached my target. They've reached the 140, and you saw how, however many attempts there were to break the 140, it didn't really want to go through. I would have thought that the 5s 30s now can relieve some pressure and go back up towards, not a lot, but this area here around 128, 129, something like that. To me, that actually is not very bullish, but this is the 10s 30s. You can see how 10s 30s is not steepening anymore, and actually it's a lower level than it was in what's this, April, May, June, July, June of last year. So I would have thought that this area here, this will go back up towards 70 basis points. So really the barbell, long 2s, short 5s, short 10s, and long 30s seems to be what dealers are going to have to put on. It's very expensive to be short of long bonds, and it's not so expensive to be short of the 10s. So I would have thought I'd like to see that go towards 70 basis points from 75 basis points, and that is the position I've been putting on over the past week. I've been covering my short in the 5s 30s because it reached my target, and I'm really now shorting the 7 to 10 year area against buying 30s. Not for a big move. I'd like to see it somewhere around here again, 70 basis points, 68 basis points. I think that is the likelier path of least resistance. This is a yield chart of the 10-year, and you can see how it has a natural resistance around the 139, 140 area. I think it's not likely to happen anytime soon, but the trend is unmistakable. We're going up towards towards that 140 level. It's going to take a while. It's going to take a long while, I would have thought, many months before we top out. I really don't see the risk any higher than this kind of area. I think we will see it in many weeks to come, but it's going to be a very gradual process higher. I don't think bonds are about to fall apart like some people think. I think this is a continued bull move in the in risk, and people are just avoiding bonds, and there is natural pressure in the bonds because of the huge amount of issuance that the United States is doing, and that it's anticipated that will continue to happen. But I don't think that that is going to produce massive swings in yields. I think that we are halfway, to where we will be, around this 140 level. I think it's very, very likely to top out. This is a chart of the 30-year yield, and you can see that more or less we have taken out. This is where we started with the panic of the coronavirus, and as you can see, we have taken out 99% of it. We are basically now at the same yield that we were before the panic of the coronavirus, and that just shows you what the expectations of the market are, that the economy is going to be fully reopened and that earnings are going to be very high. I think that it's unlikely to me that we go much higher in yield than, say, this level, that around 2%, 200 basis points, and we're now at 186. So what do we have? Another 13, 14 basis points. To me, it's very unlikely that we take out these levels anytime soon. That would indicate something that I'm really not expecting, and that is an accelerating economy with the Fed having lost control of the yield curve. I really don't think that is likely to happen. That to me says that we are getting to the end of the major trend in bonds. And this is a chart of TLT, and I keep on repeating that this 148.90, 149 level is extremely important, and I think that we will bounce off it towards that 155 area and retest it. I really don't think bonds are about to fall apart. I think they're the weakest of the asset classes for sure. There is natural issuance pressure, but a swing level from 148.90 would not surprise me at all, which would give us some sort of mild risk off. That's all that can be said about it. They are still the worst asset to own, and really no more to think than that. You trade them. Bonds are there for trading, and I would have thought I'd like to go long this 148.90 level. And really, I'm much more less bearish of 30 years than I am of 10 years, because at some stage the outcome is binary. If the economy reopens, at some stage the Fed is going to have to start tightening again. And I think the dealers will anticipate that by selling the 7, 8, 9, 10-year area and not really selling the 30s. The dollar responded to the Georgia elections by going very slightly weaker and then actually rallying. To me, this was a natural response. I think I don't think that the trend has changed at all. I think the dollar stays weak because that is probably the easiest way to get the US funding away over the course of the next several months, while the budget deficit is so huge and they pass all these coronavirus relief bills. At some stage, they will have to hike they will have to hike taxes to reduce the budget deficit, and that will be bullish. That will be bullish for dollars. But I don't think that is going to happen for many months. I think any attempt up towards this 91.01 level is going to get sold. This is just position squaring. Now, can we get a bounce all the way back up to test the underside of this trend line, which happens in the weeklies and in the dailies? You know, it's possible that's just another 1.5%, but I'm a natural seller of dollars. I think the trend is set. Whether we sell it at 91.01 or 92.62 really is neither here nor there. I think the trend is very much one of a lower dollar, and probably especially against the Asian currencies. So I'm very happy to sell any bounce in the dollar, especially against things like the Australian dollar, which I'll show you next. I showed you this chart of the Australian dollar before, and I haven't changed my mind. I think the commodity strength and so on, you know, we are here at the first resistance point around this 77.85, 78 kind of area. Some pause here for a few weeks, and then we go up to this 81.17 level. I think that that is the most likely path of least resistance. So a little bit of dollar strength over the next 2, 3, 4 weeks, and then we have some more dollar weakness. And really, when we reach this 81.17 level, we probably will have reached, you know, around that 88 area in DXY, and that should be it for quite some time. But I certainly am not changing my mind. The dollar is going to remain weak, especially against these commodity stroke Asian currencies. This is the thing that makes most sense to me. The behavior of gold last week didn't surprise me at all. I've said many times it's a second derivative of real yields and of the dollar. Both real yields and the dollar went up last week, and therefore the fact that gold got hit on Friday very hard was not surprising. The risk reward was always that it was going to go down and catch up with bonds and the dollar. Where does it go to? Well, having told you that I don't expect the yield curve to break that 140 level in 530s, having told you that I think that 10s, 30s flattens a bit, you know, 5-6 basis points, and that I've told you that the dollar I don't think breaks that 91 area, or maybe if it does it's not a lot, and that the Australian dollar does, you know, consolidates for a couple of weeks, maybe a month, and then goes and makes new highs. I think it's not really surprising that I'm going to tell you that I don't think that we are going to break 1765 in gold anytime soon, or that any test of 1765 are going to get bought for, you know, a quick $100 spurt. It's turning, okay, it's definitely turning, which to me is a good thing, because it was going up far too fast, and really the consolidation in this area with around 1810 being the swing level is not a bad thing at all. I really am not unhappy with what gold is doing. I think it's in a range, and with 1765 being the bottom for the time being, any kind of falls down there, it's time to buy calls for a quick $100 spurt. I really have not changed my mind. We're in a trading range. No way do we bust 1950, 1960 anymore. Volatility will probably come in gold. And if we look at the weekly charts, well, where is the huge area of support in the past, in the weeks? You know, it's actually around this 1710 area. This area here is, as you can see here, it's 1720 down to 1710. That area tends to support it, and really could do something like it did here. with 1760 being in the middle of the range, that wouldn't surprise me at all. I'm still a big buyer at 1760. 1765. I really don't think we break through it with any kind of ease, and if we do, it comes straight back. Lots of calls at 1765. Yes, please, thank you. And the reason why I'm so confident that gold will not fall apart is because on a spread basis it's doing exactly what I've been saying for months that it's going to do, i.e. be the between asset between equities and bonds. You know, it's definitely trending. Equities are trending up against gold at the moment. I wouldn't be surprised to see this 236 level at all. That goes back a long time. Okay, so this is these are trend lines on the weeklies that go back years. Sorry, levels rather than trend lines. So that's what, another from 220 to 236. What's that? 6-7%. While it's doing very well against bonds, you know, it's keeping its own and trying to break higher. So that tells me that unless equities start going up massively now, the downside in bonds is really, you know, the downside in gold is very limited. It's limited to 5-6%. So I'm, you know, that 1765 area to me is a no-brainer. This is a monthly chart of EM, and I'm just warning you that, you know, we are about to bust out of a, you know, multi-decade kind of pattern that I think results to the upside and has EM going a lot higher. If I try to reduce this to a weekly chart, that was a monthly chart, you know, it's showing you very much the same kind of thing. It's very bullish. Now, do we have a pullback which is buyable? Who knows? But what it's telling me is that the dollar is not about to regain any huge strength. And if that is the case, because I don't think EM could bust out on big dollar strength, and if the dollar cannot regain any strength, you're putting the pieces of the puzzle together. Gold cannot be that weak. At any, you know, it's just not going to fall apart. So all these things are pieces of the puzzle which I'm constantly trying to put together. And to me, EM shows the longer term direction of the dollar, which to me is still very much down. And these are the EM spreads against Japan, which you will agree has been in a huge bull market. Watch how EM is absolutely holding its own. You know, it's gone nowhere since 2020. In fact, it's higher now, and Japan has been on a tear. EM against Germany, the trend I think is unmistakable. And now this is becoming interesting, EM against the SPY. We broke through last week. Is this an inverse head and shoulders? Well, could be. All I know is that we are now higher than we were at the beginning of 2020 on a spread basis. So EM has performed better than the SPY, and this is in constant dollar terms, right? So you're comparing apples to apples. So even with a weakness in the dollar, which should have pushed up, the value of SPY, EM has done better. That to me is pretty telling. I think EM is building up a head of steam, that things are finally going its way. Where do I think it stops? I think this kind of level here, around the 0.15 is a target, and that is another 3% of outperformance, something like that, 3-4% of outperformance before we can see a dip. it just says to me that, any dip, EM is a buy, because I don't think that SPY is going down, and I'll examine SPY next. SPY for the nth week in the row has done nothing wrong. It comes back, it tests this beautiful moving average. My secret sauce, you buy it when it gets there and it goes straight up. That is the huge support that we have, and I've put those on the sheet. We keep on going above the Bollinger Bands. This is why, and it'll come back and then it'll go back up. We are above all the Bollinger Bands in the dailies and in the monthlies. We are not so on the weeklies. That's why I think it's going to be a bit of a grind in the early part of next week. But if you have a look at the 195 minute, it's just crawling up, the top of the Bollinger Band, and it comes back and it tests a moving average and it goes back up. What a beautiful buy level we had here at the beginning of last week. Straight up since then. It's done nothing wrong. It keeps on not closing a single day below a single important level. What can you say? To me now 37.25 is key. Closing below there is going to be very worrisome, but it's just not closing below there. Okay, and so until it does, there's absolutely no room or reason, rhyme or reason to become bearish of equities. Below there, 36.45 is going to be very, very important. I really can't see closing below either level next week, and I'm going to be buying all dips again via calls. I really don't see what the danger is. Every single piece of the puzzle is showing me the same thing. Equities, followed by gold, followed by bonds. I keep on showing you the performance of technology stocks against the broader market for a very simple reason, and that is that I can't see any significant lasting weakness in the overall market without tech being weak. I laughed last week when I saw an analyst downgrade tech stocks to equal weight. Well, the time to downgrade them to equal weight was here, right? I mean, or here. So we're talking about August of last year. So 6 months on, what do? They downgrade it to equal weight. Well, what has happened in those 6 months? The funny thing is that we've had a big steepening in the yield curve. We've had a big backup in bond yields, all things which are bearish for tech. And yet the overall effect on tech has been very, very small, has it not? I mean, what have we done really in these 6 months since tech has peaked? Well, not a lot. All we've done is consolidated in time rather than price. We're within a couple of percentage points of the all-time highs. I mean, it's like nothing. So that is why I just can't see the overall market in equities being weak. The thing that I am now thinking is that actually you could see easily tech becoming a leader, not immediately, but quite soon again, because if the yield curve stabilizes, as I've been positing and showing you, then the impediments, the brakes on tech become fewer and fewer, and the odds that it will actually start leading again improve. You know what they say, things that don't go down tend to go up. And this has shown that it doesn't really want to go down. It's basically been trading in a range. I would not be surprised to see it bust through the top of the range. And if it does, then we have one hell of a rally on our hands. And in fact, NQ is a very, very clear technical chart. 12,450, 12,550 is the area that it must not break. And in fact, what does it do every time it goes down there? Straight back up. I think it's very, very clear that that is major, major support. Every time it dips there, call buying like crazy. We are within the weekly Bollingers, and at some stage we just accelerate higher, don't we? So that is becoming clearer and clearer to me, that the swing level is 12,450 to 12,550, while we hold this moving average on the weeklies. The trend in everything and in tech is up. And that view that at some stage tech leads us higher again is the thing that why I'm beginning to be fundamentally interested as opposed to just technically interested in SPY over IWM. We absolutely bottom ticked it here. I'm any kind of dip into here, and I think next week we'll probably get a chance to do this trade. It's becoming not only technically interesting, it's becoming fundamentally interesting, because if we are topping out in the yield curve, that actually tops out financials for a while, and it gives us a chance fundamentally and technically to see this level around 193 again. You know, that's nearly a double-digit move in the spread in terms of percentage points. So I'm now even more interested in doing this than before. So finally on to the summary sheet. 210s achieved my 87 target. I'm out. I really can't see it unless my maths is wrong, and I doubt it. I cannot see it higher than 104. It's just too expensive to carry. 530s achieved the 140 minus 140 level. I'm out. I now just don't think that I really want to trade 530s. As I told you, I want to trade the barbell between 2s, 5s, 10s and 30s. I think 5s and 30s stay weak in terms of future price, and the 30s start getting bid and the 2s go nowhere. I'm a better buyer of 30s rather than 5s and 10s in futures terms. I think slowly we go back towards the 135, 133 area. I don't think this is relevant anymore. I think around the 133 area is where we are going to go if we go anywhere at all. Dixie, I've said that 88.44 is the first real support. We got to within a whisker of it, and now 91.01 is to 92.62 area is the big resistance level. I would expect probes to 91.01 next week. Gold, I've told you that I don't think it goes through 1915.25 anymore for quite some time, and now 1810 is the first support, but the real support to me is 1765, and at 1765 I'm a big call buyer because of this, and this all fits with the 5s, 30s, with the 2s, 10s, with the 2s, 5s, 10s and 30s. SPX, what I think is happening is they're making you front load. They're telling you that earnings are going to be 180. I don't think earnings are going to be 180. I think earnings at best are going to be in the mid 160s. But they're pushing you to go towards 39.60, and we're going towards 39.60. I think that is almost a given. The short-term technical levels are very obvious, 37.25. Before that, 37.82 is intermediate support, but if we go through 37.82, we get to 37.25. At 37.25, you shut your eyes and you buy calls. Resistance, well, Where is resistance? Weekly Bollinger's around 38.80, something like that. As I've told you, I think this is the level that we're going to over the course of the next 6 to 8 weeks. And that's all there is to be said for that. NQ, it's, you know, the surprising part is how it has not underperformed more, and therefore this 12,550 level is equivalent to me to 37.25 in the SPX. As long as we're above that, we're going up, and we're looking for the upper end of the Bollinger Bands, both in SPX and NQ. EM, I keep on talking about it, 55.83. We are going to bust, and people are going to chase. It's going to be a panic at some stage. Not yet, but at some stage it becomes a panic. I'm a better buyer of EM, well, on dips than I am even of XPX and NQ. It just fits in with my narrative. Nikkei keeps on going up. I keep on saying 30,000 will trade. You know, we'll get there very, very soon. And this, you know, SPY, IWM, I'm now becoming even more convinced of it, as I've told you. And 182 down into the 180 area is definitely a level of interest. Thank you very much indeed, and tweet you on Monday.